Hi, and welcome to the Day Trading for Beginners podcast. My name is Tyler Stokes from StokesTrades.com, and this is episode 11. And in this episode, we are talking about options. So we're going to talk about what options are, and it's going to be very much a beginner-friendly introduction to options. So, as I'm talking right now, I glance over on my desk. I've got this Options as a Strategic Investment textbook. It's like 1,000 pages. So there are a lot of things to learn in regard to options, but we got to start somewhere. We are beginners, and we're going to do an introduction to options in this podcast. Now, in future episodes, we are going to talk more about options. And, we're on a journey to become a full-time day trader. I do believe that the strategy I will use options. Again, you don't need to use options to day trade, but if you're going to be a day trader, you certainly want to understand what they are and how they work. And that's what we're going to cover in this podcast. Now, before we get started, in the show notes, I am going to have a video version of this podcast. We're going to run through 2 examples, and you might want to actually watch those in the video format on YouTube, because I am going to have sort of a whiteboard presentation so you can sort of see the numbers on a screen. That might be a little bit more helpful. And then again, you can download my 6-month blueprint that outlines exactly what I'm doing in the first 6 months to become a full-time day trader. You can find that in the show notes, or you can go to StokesTrades.com/blueprint, and you can download that for free. And then when you do that, you can learn about our online community. If you want to be a day trader, you can join the community. It's free. There's no one selling anything. There's no courses. There's no ads. Everything is free. And it's a community where, I can meet you. We can talk. We can be accountability partners. We can have discussions, and we can learn and become full-time day traders together. So again, that resource is below in the show notes. So let's get started. What are options? So what we're going to do here is sort of take a first principles approach to what an option is, and then talk about the 2 types of options, how you can buy them, and then talk about a few more sort of definitions in regards to options. So again, this is very much a beginner's sort of introduction to options. So at their core, options are contracts that give the buyer the right, but not the obligation, to buy or sell a certain asset at a specific price before a certain date. So there's a lot that's sort of compacted in that one sentence. So options are contracts. So not in the sense where you need to read the contract, read the fine print, and get a lawyer to sort of sign off on it. All of this buying and selling these securities, they're all done on your brokerage account, and it sort of happens seamlessly behind the scenes through one click, and then it's bought on an exchange. But at their core, they are contracts. And when you buy them, you have the right, but you never have the obligation to buy or sell the underlying asset. And the underlying asset in our examples are going to be stocks, but you can have options for commodities and ETFs as well. So this term underlying refers to what the option sort of is about. So we're going to talk about stock options. So an option gives the buyer the right, but not the obligation, to buy or sell a stock at a specific price before a certain date. So when you think of how a contract works, there's always going to be someone who writes the contract and then someone who buys the contract. And you could be either one. But for this episode, we're just going to talk about buying these contracts. Now, before we go further, let's just quickly talk about the difference between buying a stock versus buying an option. This is going to help us understand what these are a little bit better. So when you buy a stock, it's yours to keep. You own a piece of that company. So if you, buy a stock for the Tesla company, you're going to own a tiny bit of that company. Now, imagine instead of buying stock right away, you pay a smaller amount of money for a special ticket. Now, this ticket lets you decide later if you want to buy the stock at today's price, no matter if the price goes up or down in the future. So this is like buying an options contract. You do not own the stock yet. You just have the right to buy or sell it later at a set price. So again, buying these contracts gives you the right, but not the obligation to buy or sell the stock in the future at a specific price. So there's some key terms to go over. So this idea of set price, that's referred to as the strike price or the exercise price. So that's the set price at which the stock can be bought or sold, and that will be within the contract. Now, the expiration date, that's the date at which the option must be exercised or it becomes worthless. So there's a finite time limit with these options, and the expiration date is sort of like the last day that you can decide to either exercise the option or just let it expire worthless. And we're going to talk about exercising options. And then the other key term is premium. So that is what the option costs. So how much do you pay to have the right to buy or sell the stock at a certain price in the future? So that's like the cost of the option. That's referred to as the premium. And then there's this idea of intrinsic value, which we're going to understand when we go through an example. And then this time value as well. So, time value is the part of the option's premium. So the cost that reflects the time remaining until expiration. So there's a whole sort of strategy with how these options get priced because, as the expiration date gets nearer, that's going to change the value of the option because, there might be less time for the stock to, reach the strike price, or, fall below the strike price if it's a put and so on. So there's, those key terms: strike price, expiration date, premium, and then intrinsic value and time value. So there are really two types of options, and we want to talk about the way that they are priced as well. So the two types of options are call options and put options. So call options, they give the buyer the right to buy a stock at a predetermined price. So that's the strike price within a set time frame. And then on the other side, you've got put options, and this gives the buyer of the contract the right to sell a stock at a predetermined price within a time frame. So why would you buy a call and why would you buy a put? So if you are bullish on a stock, so you think the stock will rise in the future, you can buy a call option, giving you the right, but not the obligation, to buy the stock at the strike price. And if the stock price rises above that strike price, you can profit by exercising the option. Now, buying a put is the other way around. If you are bearish on a stock, so you think that the price of the stock is going to fall, you can buy a put option, giving you the right to sell the stock at the strike price. And if the stock price falls below the strike price, then you can profit by exercising that option. We're going to talk about that in our examples. Now, in the options market, we have to remember that one standard contract, it represents the right to buy or sell 100 shares of the underlying stock. So this is sort of like a standardization, and it makes trading, a little bit more efficient and easier. So when you see an options price quoted, it's usually the price per share. But because, one contract, just think of it as like one box or one envelope. These contracts, they cover 100 shares. So you're going to need to multiply the quoted price by 100 to get the actual cost of the contract. So, if a call option's quoted at $2 per share, it's going to cost you $200. So $2 times 100 to buy that call option. So let's go over some examples here. And again, in the show notes, I'm going to have a link where you can watch a video where we have this sort of demonstrated on a whiteboard. So for a call option, we are bullish on the stock. So imagine, you believe that this stock, we'll call it XYZ. It's currently trading at $50 per share. You think it's going to increase in price in the next month. So you decide to buy a call option with a strike price of 52, and it expires in 1 month. Now, the cost, the premium of this contract, of this options contract, is going to be $2 per share. So it's going to cost you $200, $2 per share times 100 shares to have the right to buy 100 shares of stock XYZ at $52. And that's going to expire in 1 month. So there are two scenarios here. Either the price goes up or the price goes down. So let's pretend that the stock now rises all the way to $60 before the expiration. So your call option, again, gives you the right to buy shares at 52, even though they're now worth 60. So you could exercise the option, which means you buy the shares at $52 and then you immediately sell them at 60 because that's the market price, and you make a profit of $8 there. But remember, you paid $2 per share. So your net gain is going to be $6 and essentially $600. So it's going to cost you $200. You made $800. So your net gain is going to be $600. And then the other scenario would be if the stock remains below 52. So it was at 50. And if it sort of never rose, then your option would expire worthless, because why would you buy something at a strike price of 52 if the price is currently less than that? You would never exercise that option. It just becomes worthless and you lose your $200. Now, when you do exercise the option, again, like I mentioned, it happens instantly and seamlessly at your brokerage firm. You just hit exercise and then your firm is going to allow you to buy the shares at 52 and then immediately sell them. And you're just going to see that gain of $8 and then, minus the premium that it cost you. So, you don't have to worry about doing those steps. That sort of happens seamlessly at your brokerage firm and within your account. So the other example is buying a put. So that was a call where we thought the stock went up. Now for a put, say you believe, company ABC stock, it's currently trading at $100 per share and you think it's going to decline in the next few months. So you decide to buy a put option with a strike price of $95 and it expires in, say, 3 months. The premium for this option is going to be $3. Let's see some scenarios. Scenario one is if the price does fall. So if company ABC stock falls to $80, your put option allows you to sell shares at 95. Despite the market price being 80, you can exercise that option and you're going to make a profit there of $15. So 95 minus 80 minus the $3 premium that it cost you. So you're going to net $12 per share. You'd make $1,200 with that trade. The other scenario, if the stock remains above 95 or rises, your put option is going to be worthless. Why would you would need to buy the stock at a high price and then sell it for a low price. So it's never going to work there. So sometimes when you think about these things, it gets a little confusing there, but you would never exercise a put option if the stock did not fall, because there's no price profit there within the price difference. So with those two options, we looked at basically what's called in the money and then out of the money. So these are two terms that are associated with options. In the money option. So for a call option to be in the money, a strike price in our example there was 52. And if the current market price of the stock is 60, that call option is in the money. We would want to exercise that potentially because we have the right to buy at 52 and the stock is at 60. So we can buy at 52 and sell at 60 instantly within our brokerage firm. So that is in the money. And there's some intrinsic value there. So there's that $8 of intrinsic value. The stock is selling for 60. We can buy it at 52. We've got $8 of intrinsic value. Now for put options, we saw in those examples, if a put option's strike price is 95 and the current price of the stock is 80, that put option is in the money. We have the right to sell it at 95, but we can buy it at 80. So there's that $15 worth of intrinsic value. And again, in your brokerage account, if you were to exercise that option, it would automatically buy at 80 and sell at 95 for you. And then out of the money options would just mean that those strike prices don't align properly with the current market value for either call or put options. And then you've got this term called at the money. And that just means when the strike price is equal or very close to the current market price of the stock. Now, there is some significance with in the money options and out of the money options because, more in the money options, they're going to be more expensive because they have some intrinsic value, and there's a higher probability that they're going to be profitable when you exercise them. And then out of the money options, they're going to be cheaper because they lack that intrinsic value, and they're riskier, especially when you consider how much time is left with the contract. So traders often choose between buying in the money options or out of the money options, again, based on risk tolerance, what the market's looking like, and then sort of what their strategies are. So we talked a lot about exercising options, and there's just one other thing to consider before we talk about what most traders do. When you exercise these options, you need to remember that these contracts are actually for 100 shares. So you do need sufficient funds in your account. For instance, if the strike price is say $50 and you exercise a call option, you need $5,000 to exercise that call option. So $50 a share, and your contract is always for 100 shares. So, you might have $5,000, but some stocks, when they're a bit more expensive. So if you think of Amazon stock, there was a stock split, and it's sort of, at the time of recording this, in the range of 150, but for a long time, Amazon stock was like $1,000. So if you had call options that you wanted to exercise, you'd have, $1,000 times 100 shares, you'd need $100,000 to actually exercise these options. So what you would do, which most traders are going to do, and especially us day traders, we're going to sell options before they expire. So most traders typically don't plan to actually exercise their options. We want to realize profits or limit losses before the expiration date. So, day traders were often buying options with the intention of selling them for a profit before they expire. So if the value of the option, increases due to a favorable, movement in the stock price, either way, you can sell the option at a higher price that you paid for it, and you're going to get a profit there. So in terms of, thinking about this, who's buying these options? Well, you've got traders like us, we call speculators, and then you've got hedgers as well. So, other traders may be willing to buy these options for various reasons. So if you have an option that's in the money and you want to sell it, someone else is out there. We have to remember that the market's huge. There's so many buyers and sellers. If you want to sell an option that's in the money, you will most certainly find someone on the other end. And then if your option is currently out of the money, you might be able to price it in a way that someone wants to take that risk for whatever reason. So there's always an option to usually, sell your options before they expire. There are certain scenarios though where, your options are just going to expire worthless. If it's out of the money, and no one wants to buy it, then, you're going to just lose. So there's always some loss potentially with these options. Again, there's several ways that they can go down. You can exercise the options. So if they are in the money, you can exercise them if you wish. Options can expire worthless. So if an option, expires, the buyer is going to lose that premium. Again, you can trade them. So you can often trade before expiry. And then hedging, some traders use options for hedging. Their gain or loss on the option might be offset by changes in the value of the other investment. So again, it's more of an advanced topic, but there's a lot of strategy that can go on with how these options are covered. And I think here is where we could stop for this introduction. So we really talked here, what options are there? Contracts. They give you the right, but not the obligation to buy or sell a stock at a predetermined price. So that's the strike price. And there's always going to be an expiration. So these are sort of referred to as like a wasting asset because, there's a time limit that happens with these contracts. So, as the time approaches expiration date, the price of that option, the value there might change because, there's less time for the option to be in the money. And there's a lot, again, that we haven't covered here that we will cover in future episodes. This is very much going to be just an intro lesson. We can talk about, option spreads. We can talk about options on futures and other derivatives. We can talk about, selling options. All we talked about here was just buying them. You can also sell them, and there's strategies involved there. So again, options are, it's a big topic. I personally think that I will be using them in my day trading strategy. You certainly don't need to, but it's good that you have a good understanding now about, what they are. And I hope that you found this useful. And if you are listening to this here, certainly consider downloading my 6-month blueprint. It outlines exactly what I'm doing. And you can come over to our community on the school platform. There's no selling. There's no courses for sale. All the information is free, and all of the processes that we're going to go through in the first 6 months. And as we continue this journey to become a full-time day trader, we're going to have free courses and guides over in our community. And, if you want to talk to someone about day trading, maybe you're looking into this, and you don't really have someone that you can talk to, or people are going to tell you you're going to lose money and they don't support you. That happens, unfortunately, with friends and family. But you can come to a community that we're creating. We can talk to us. We can introduce each other. We can meet each other there. You can find accountability partners. And again, you can learn all about that when you download the blueprint that's in the show notes, or go to stokestrades.com/blueprint. So thanks so much for listening. Subscribe to the podcast, and we will talk in the next episode. I look forward to talking with you then. Take care.